At a time we don't have anybody, unless you're talking about benefit improvements.
Carrie?
Unless you're talking about benefit improvements, then you'll get a crowd.
Well, I went down to see one of your corporals 2 weeks ago at the police department.
Okay, you guys, go ahead. Thank you.
All right. Very good. We'll call the meeting to order again. Chris, if you'll call the roll.
All right. Dylan Renz?
Present.
Chris Salzman?
Present.
Jerry O'Halloran?
Present.
Jim Wilton? Sam Kibbers?
Present.
Okay, with 5 trustees present, we have a quorum.
Very good. We'll open up to public comments. Seeing that there's nobody else here, we'll move right on. Approval of the minutes from our June 16th, 2022 quarterly meeting. Do I have a motion to approve?
I'll make a motion.
Second.
I have a motion and a second. Any further discussion? All in favor signify by saying aye.
Aye.
All opposed? Motion carries. Moving on to the consent agenda. We have payment ratifications for warrants number 32 and 33. New invoice for payment approval for warrant number 34 and fund activity report for June 10th, 2022, which will be in your packet here.
We're getting a little feedback, so turn your mics off if you're not using them.
Do I have a motion to approve the consent agenda?
I'll make a motion.
I have a motion. Do I have a second?
Second.
Motion and a second. Any further discussion? All in favor signify by saying aye.
Aye.
All opposed? Motion carries. Moving on to new business. Update on trustee terms. Scott, is that something you're talking about? Or Chrissy?
Yeah, that's me. So yes, at the last meeting, the board did reselect Sam as the 5th trustee, and City Council has since ratified that position, so he will serve another term. Also, Jerry O'Halloran, his term expires October 4th. The city is very proactive with reaching out to people whose terms are expiring, and they have since done that. His name has already been presented to the council, and he has been reappointed, so Jerry will also serve another term.
Very good. Glad to keep you on board, Jerry. And the proposed 22-23 budget.
Okay, so Florida statutes does require that the plan operate under a budget of administrative expenses. So this is just an exercise that we do every year before the new fiscal year. From left to right, you can see what the actual expense amount was as of 9/30/2021. Then the next column to the right of that is what we budgeted for this fiscal year. And then to the right of that is what the plan has actually spent through July 31. And what I'm proposing for the fiscal year 2023 is in the far right column. I did increase the actuary line slightly. If you recall at the last meeting, you did approve the fee increases for both actuarial and administrative services, so I bumped that up to $30,000. The only other, I did bump up the custodial expenditure line as well, because those custodial fees are based on your assets. So as the plan grows, so will the custodial fees. So I bumped that up to $18,000. And I also increased the insurance expenditure line just because, just like the custodial fee, the policy premiums do tend to increase as the plan grows in assets, so I bumped that up to $5,000. And then I also increased the investment consultant line because at the last meeting you also approved a fee increase for Carrie. So we're looking at a total budget amount for fiscal year 2023 of $141,000, which you are able to go over any over budget in any one expenditure line, as long as we don't go over that bottom line amount of $141,000. Are there any questions about any of the line items or suggestions for changes?
Maybe just for information purposes, because Jim, this is the first time you've done this, I think, and this is not a budget in the budgetary sense. It's basically a state requirement that says that we have to essentially do this drill to estimate what we think we're going to spend next year. And the reason why she said we make it a little on the high side is because the worst case scenario is if we do go over the 141, we'd have to come back and do an amended budget and resubmit that to the city and the state and what have you. So it's not that big a deal if we went over, but this isn't every dollar on here is what we expect to spend. It's kind of an estimate of what we're doing. I call it legislative busy work because that's really what it is. It's really, we're going to spend what we need to spend to operate the plan, you know?
Now, I see on here that's auditor, zeros across the,
We must be using the city audit. We're using the city audit
That is correct.
so that we're not paying separately for that. And I can see that I'm woefully behind on the estimate for this year. I'll try to do better between now and the end of the fiscal year.
All right, very good.
Can I ask a question?
Sure.
Can you be more specific? What is it that the physician does?
Physician fees are if we have a disability claim,
Yeah.
we have to do an independent medical evaluation. And and it's not fair because I basically arrange the independent medical evaluation. I set it up, and then the doctor bills me, and then obviously I pass that along to the plan. Well, if that $2,000, $3,000, $4,000 it's included under legal fees, it's not really legal fees. So years ago when we started to do this, I asked them to do a separate category to basically pull that out. So if we have a disability, we have an IME fee, it'll appear there and not under legal
Okay.
fees.
And last year, we didn't have any.
Apparently not.
Okay, good. They're healthy.
We didn't have any disabilities, so that's
Okay.
good.
All right, very good. Do I have a motion to approve the budget?
I'll make a motion to approve the budget.
Second.
I have a motion and a second. Any further discussion? All in favor signify by saying aye.
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 All opposed? Motion carries.
And then at the next meeting, Chrissy will give us a list of the actual expenses in these categories, the actual expenses that we spent in the current fiscal year that we're in, that we're just about to finish, and then we'll approve that report as well. That's the second part of the legislative busy work. So we will do that as well.
All right, old business, discussion of investment return assumption.
Yes, this discussion was actually tabled since I believe it was the March meeting. The board's assumption is currently at 7%. And I know there was discussion of reducing it down to 6.75%. Now that it's closer to the end of the fiscal year, I thought this would be an appropriate time to talk about that with, especially with Carrie here, we may be able to provide some feedback as well, and Kristen as well.
To refresh, I thought didn't we approve it to go to 6.75 already? Does anybody remember? Or we were waiting to do it later?
I don't remember why it was tabled.
Actually, I've got, in March, I have a note that says delay 6.75% to September.
Because we were gonna,
Discussion. And I think the reason for that was we wanted to see how we were gonna do during the fiscal year from an investment standpoint. Because remember, reducing the assumed rate of return increases the required contribution.
and I also want to say, wasn't it because we wanted to do it on the fiscal year? Beginning of the fiscal year? We didn't want to do it midway because then they,
Right, well, if you made a decision today to go to 6.75, then the actuary could, when he does the 10/1/22 valuation, actual valuation, he could use that change in that valuation. That's why we were doing it at this meeting.
yeah, I think it had something to do with the fiscal year.
Yeah.
They didn't want to do it mid-year because it was going to require some additional work.
Well, no, it would have, like I said, I
Yeah.
think we put it off so we could see what the year was gonna look like from an investment standpoint.
Yeah.
Because obviously, if we make less than the 7%, which we are likely going to do,
Yeah.
that's gonna have the effect of potentially increasing the required city contribution. And if we reduce the assumption also, that is also going to result in increasing the required city contribution. Now, Kristen may want to talk about that because I think they're already putting in more than what they're required to do anyway, but that was kind of the reason why we postponed it.
Kristen Simeone, Finance Director. We are not doing that for the police department.
Oh,
We were
okay.
only doing that for the general fund, the general employee pensions, because it was a closed plan and trying to increase the, our funding percentage for, or, you know, bring down that unfunded liability.
We actually, in March, had a study that was done by Foster & Foster, and if we reduced, what is the yes? Sorry, I didn't look at this. Oh, ad hoc COLA. Yeah. Okay, well, then the no. So basically, it would go, we're currently at $480,967 is the city required contribution with the 7%. And if we went to 6.75, it would be 568,000. So from 480 to 568. That doesn't take into account the investment return for the year. That's just based upon last year's actual valuation. So it would be even more than that. I don't know if that gives you enough information to make a decision or not, but
Didn't the, wasn't the fire gonna drop it also? Fire was going to 6.75 and
fire, I don't know, because I don't do the fire. General was already at 6.75, and they kept it at 6.75.
that's 7?
But they're a closed plan.
I thought we were, I'm just conversation. I thought we all thought we were gonna do this, right? We were just putting it off. I think we kind of said 6.75 was the number. We were just waiting. So I remember when Foster & Foster did the presentation, is the city gonna have an issue if we go to 6.75? Are they planned for it?
So no, it was not planned for the 6.75. I think the other issue too is there's also union negotiations going on that are possibly going to be increasing the pension costs as well, that the city is going to have to contribute. There, I'm not sure if I'm allowed to talk about it.
Probably not.
But
Do you have any time frame for when that might be done?
no, I don't have a time frame. We thought we might have heard something before now. I know they do want it to try and do October 1st or very shortly after, but because I don't think they're going to make the next council meeting. So
Is that something that we need to do today?
Well, obviously, you don't have to do anything. You can leave it at 7, okay? The only reason we'd potentially want to do it today is because the actual valuation is done as of October 1st. And obviously, we don't meet again until December, right? So if they want to start working on the actual valuation, they really can't finalize it if they don't have an assumed rate of return that they know we're going to be using. I don't think we want them to do it and then go back and redo it, you know, with a change in the assumption to 6.75 if we did it at the next meeting.
Yeah, they're doing it all at the, it's kind of coming back to me now. I think it was, we were just do it so when we did it at the time of the year, when we did the next actuarial, we would use the correct figures.
Right,
We wouldn't have
exactly.
to do it midstream throughout the year. And if
Right.
If we don't do it now, we'll wait till December, then we have to go back, they have to do the report again. It's like doing twice the amount of work.
Yeah, either that or do it for the following year.
You know, the discount rate of the assumed assumption really in the end is just how much of an unfunded liability you want to have. And that's really in the end. It doesn't, we could put it at 10 or we could put it at 2. It wouldn't have any effect on, really on anything.
We wouldn't get away with either one of those.
I know we wouldn't. The point is, the extremes of it, but the point is it's if we're only getting 6 and we keep saying we're getting 7, 7, 7, then, that'll catch up over time. And
I think it also does affect the contribution that would be
Yeah.
required, because obviously if the unfunded liability goes up over that long term.
Yeah,
So I think there were 3 factors in play when you guys were maybe deciding to put this off. First, there was the cost of living increase that was being requested, which would have been an increase to the city's cost. And that was an ongoing cost. You've got the union negotiations, possibly increasing the city's costs, and then now you have this. So it could be a triple whammy, but.
And also this year's investment return.
And then this year's
Yes.
investment return as well, yeah. So the prior year, you had a good rate of return, so I think at the very beginning of the year, it probably looked good to maybe make that change. I don't know about at the moment, so.
what do you two think about it? I'm indifferent as the 5th member. It doesn't really matter in the end.
I think with the fluctuations of our current market conditions, I think it might be best if we don't make a judgment on this right now.
What is it currently?
7. And that's not out of bounds. I mean, FRS is 6.8, and I have a number of clients that are more than 7. So, I mean, the state is starting to write letters about wanting to be between 5.75 and 6.75, but I mean, they're not withholding money or anything based on it. They're just mentioning in passing that we ought to be looking at reducing it. But, most of our plans are, with the investment return this year, you're trying to avoid a double whammy, like I said earlier, but with the bad year of investment returns, increasing the required city contribution. And then if we do this, that would be a further increase. So
I mean, if you are doing negotiations and all these other things, it's just going to snowball it to at some point. The city's really going to have to put in a bunch of money, and then that's even going to hurt your chances of getting raises and all the other things even worse. Because if we continue to have low investment returns because of the market, that's just going to be a bigger and bigger underfunded liability that you'll have to pay. So,
well, I think I said before, we don't want to link your decision on this to the union negotiations, but.
What's the triple whammy? That's one of the 3
Yeah,
things.
it could be. And by the way, just in passing, the ad hoc COLA that y'all approved last time, I did send that ordinance to the city. And again, Kristen, you may want to talk about this, but essentially what the city manager told me is that they want to look at all 3 plans together with regard to this ad hoc COLA. And so they're going to postpone any action on the request that the police made to take a look at all the employees at the same time with regard to an ad hoc. I think that's basically it.
That's correct.
And is that a decision that's going to be made in the near future, I'm assuming?
It's going to be during this fiscal year coming up, so I think it will be, very quickly into the new year. I don't know how quickly, but again, it'll depend on budgets and everything that is available to fund a COLA for all 3 plans.
I think this might be prudent to just wait until December and revisit this. We'll at least have a couple of these unknowns answered by then.
If we wait until December, and that's my inclination also, what other impact would that have on the city? Would that hurt them? Would that delay their processes, or?
Well, we would just, the Foster & Foster would just calculate based on the 7%, and then if you change it, we can just make it prospective for the following year.
Okay. So it would delay a year, basically, okay.
Yes.
We should move on to the next item then. We're not doing anything.
Okay, so I guess we have a consensus that we're not going to take any action on changing the assumed rate of return. Maybe that's what we're putting in the minutes. I don't think you have to take any formal action. Just note that we talked about it and we're not going to make any change. Good?
We'll get that on the next agenda. All right, moving on to reports. Carrie? You're up.
Okay, so straight to just kind of ripping off the Band-Aid, we'll start with that June 30th book. And we'll flip in your books to page 4, which is where the kind of the economic section starts. So on that top right chart there, you can see very strongly negative quarter, really for publicly traded stocks and for bonds. We've been in a somewhat unique environment where obviously there's a lot of uncertainty around there surrounding when inflation kind of starts to tamp back down a little bit, whether the aggressive moves of the Federal Reserve will cause a recession, et cetera. Supply chain concerns, geopolitical events, really kind of just causing a lot of uncertainty and a lot of fear and discomfort in markets, and that's what you see kind of on the equity side of the ledger. And then when you look at fixed income, we know that the Fed has aggressively been hiking rates. We got a 50 and a 75 basis point rate hike just through the quarter. They meet again next week. We'll probably get another 75 basis point hike then. And so that's negative for fixed income. So we found ourselves in this quarter where, again, both publicly traded stocks and bonds were pretty strongly negative. Within equities, the S&P was down about 16%. Mid and small cap securities down slightly more than that. Overseas markets were also negative in kind of the mid-teens, with the exception of emerging markets, which was down about 11.5. And then, as I mentioned, of course, the aggregate is going to be negative when you see such pronounced rate movements over the quarter. So the index was down about 4.7. But even certain segments that had been safe havens for the last prior few quarters, like tips, were down over 6%. It was very much a kind of a risk-off, high-quality type of quarter. You can see there the worst performing segment was investment-grade corporate credit. Couple things going on there. Investors not wanting to take as much corporate credit risk, but also those bonds tend to be long duration. Companies have issued some very long duration, low coupon debt. And so there's a little bit more kind of sensitivity there, but just really, long story short, very challenging period in both equities and in fixed income because there was really nowhere to hide. This is the second quarter in a row where we've kind of seen this phenomenon going back 100 years. There's only 2 years on record where both stocks and bonds kind of finished down, so it's a tough and a kind of somewhat rare period again where, again, kind of nowhere to hide except cash and some pockets of real assets. On the 1 year basis, again, just the magnitude of the difficulty of the last couple quarters have brought all the indices negative on the 1 year basis too. The S&P is down about 10.5. Mid and small caps down more than that, anywhere from kind of the high teens to 25% for small caps. And then overseas markets are down kind of, let's call it kind of high teens, with the exception of emerging markets down over 25%. Fixed income down 10% on the 1 year. The good news there is the aggregate had been yielding very little to almost nothing for a long time. The yield was about 1%, call it a year or so ago on the ag. It's closer to 4% now. And if we continue to see rates move up, we'll expect to see that interest move up as well. So we will be collecting more income on our fixed income. So that's one positive in what has been a very volatile market, kind of depending upon what markets think, whether the Fed will live up to its obligation to continue to hike rates for the rest of the year, whether they may back off a little bit. So it's been a very volatile, emotional kind of time in markets. If I flip in your books to page 11, we'll just take a quick look at that bottom right chart there. That's just a good visualization for rising interest rates. So the green line is where we were at the end of March. The yellow line is where we were at the end of June. And just to pick a point on this chart, if we look at the 10-year, it was at about 3% at the end of June. It's been hovering closer to 3.50. So again, we just continue to see that march upward in interest rates in a pretty dramatic fashion as we try to get the inflation under control. Any questions on the economics piece? So flipping in your books then to 12, we'll get into the pension-specific information. And at the end of June, the fund had about $20.7 million. To be specific, it was $20,692,186. Almost 52% or 51.7% was in domestic equity. About 14% was in international. roughly 31.5%, 31.6% in domestic fixed income, less than 2%, just a small piece in global fixed, and then a bit of cash as well. And if we flip ahead to 14, it's a little bit of a better view of your allocation there. Equity, both international and domestic, are slightly underweight, but really not by much. Domestic fixed is a bit overweight, global fixed is underweight, but if you kind of put those two together, that's really been by design. Because when we fired Templeton, we went ahead and reallocated those monies to domestic fixed income instead. So really, actually, your asset allocation, considering all things, is pretty closely in line with where you all, with what your policy states. So I don't have any recommendations for rebalance. We did get your state funds at the end of August, and just because things are so volatile, I would recommend that we just keep that in cash for our planned needs. We do tend to use a couple, I think it's mid-150s or something very similar to that every month for your distributions, and so that'll cover a couple months of distributions without us having to raise cash in your portfolio. So I think that's a smart thing to do in a market like this rather than raising funds from selling. But other than that, no recommendations for any changes to your asset allocation at this time. And if we flip ahead to 17, we'll just quantify the quarter there. So on a gross and a net basis, you were down about 12.5%, and the index was down about 12.4%, so pretty much on top of that. Last quarter, as I mentioned, was also a challenge on the fiscal. As of the print of this book, we were down about 13.2. The index was down about 12.9. And then just giving you a little bit of longer term perspective, the 3 and the 5 year numbers have been dragged down. The 3-year net is about a 5.6. 5 year net is about a 6.6. You are still tracking at a 745 on the 10 year. But certainly I've seen some reductions there in the 3 and the 5 year just due to the challenging period. Within equity overall, down about 16.4. The index was down about 15.9. Within domestic equity, again, that total stock market index down 16.8. Within international equity, down 15. The index was down 13.5. WCM focus growth down 17.44. The international kind of core index down 13.5. The growth bias of that fund is a big drag. We've seen kind of growth really pull back as interest rates have started to rise. So some of the sectors that were very hot during COVID, in particular kind of semiconductor and other technology types of orientations, have really pulled back and given back some of the gains that they got during that COVID period. And you all have, as the other complement to that, the Vanguard Total International Stock Fund, and that was down just shy of 13% on the quarter as well. Flipping to the next page, overall in fixed income, we were down about 3.8. Domestically, we were down about 3.7. The index, again, down 4.7. So some of that shorter duration positioning and a lack of BBB exposure did help you a bit in the challenging environment. And then the international bond fund was down a little bit more than 5% there. So again, very kind of challenging quarter and kind of a volatile time. I think the best thing you can kind of do is stick to your asset allocation, try to hold your nose and kind of rebalance through the volatility. Because I don't see it abating anytime in the next few months with the election kind of coming up. And obviously, again, there continues to be a lot of things kind of hanging out there as question marks. So a good period to kind of stay the course. It's natural to go through some volatility like this. The last few years we'd had before this had actually been very calm and tame, kind of uncharacteristically so. So certainly from time to time we go through periods like this. And again, kind of the best thing to do is maintain that very long-term focus and kind of stick to our asset allocation. So any questions on your June numbers book or anything else there?
I've got a quick one. You know, WCM, again, it's 4% less than the index. We would have been better off just buying the index again on this. I mean, we look at this every quarter and it never gets better. Actually, this quarter's even worse. Last time we looked at this, we were going to hold on for 3 months and see if it would get better. And obviously looking at it now, it's not doing well.
I mean, there's no doubt that the growth orientation has been out of favor and honestly probably will continue to be. In a rising interest rate environment, you see that. I mean, if you look at their longer term numbers, and again, these are net of fees, 495 versus 181 on the 3 year.
Yeah, but the last 2 years, it's, look at the fiscal year to date, it's down almost 10% less than the index.
Right, I mean, but
So
we
in-
take a longer-term focus, right? Typically, you're gonna judge a manager on a 3- and 5-year basis. They're still 783 versus 298 on the 5-year.
They
I
got
mean,
lucky-
again, the styles, it
They
has
got lucky
been-
the first 2 years they were there, and the next 3 years, they did terribly.
Yeah, I mean, maybe they did get lucky, but no matter what you want to say, it was additive to the plan. So, I mean, you know how I feel about this, Sam. Feel free, make a motion, index it all. I think they've done a great job for you, and again, those returns are net of fees, but it makes no difference to me. If you guys, you know, if you want to move to the index, go for it.
It's kind of like the sore thumb of our portfolio.
You have, and I'm having trouble finding it, maybe it's me. You have international equity. Do you have international fixed somewhere and I just can't find it?
Yeah, it's on 18, Jerry. It's the last item, and it's just a very small piece, that Vanguard Total International Bond.
Okay.
It's that last item on 18.
Got it. I was looking at the pie charts and I don't see any place right there. That's why I was wondering. But it is a very small portion.
It's technically it's called Global Fixed in yellow, and honestly, Jerry, it's so small on page 12 that you can barely see it. So that's probably why. If you look at the kind of allocation chart on 12, it's a
Oh, I see
very
it.
bare sliver of yellow.
I see it now. Okay, I'm sorry.
Oh, no worries.
Yeah, that is kind of, oh, good. I didn't think we should have a whole large portion in there.
Yeah, and you don't. We had terminated Templeton, and we put the money back into domestic. We didn't, you know, kind of look for something else for that piece. So that's why that piece has been very small.
Yeah.
But else, I'm gonna make a motion. Does anybody want to discuss it anymore before I do that?
Yeah, emotion's gonna be talking about using the index as opposed to,
WCM, yeah, just putting it in the Vanguard index.
and what's wrong with WTM?
In the international equity area, it's the top one.
Well,
That focused international growth.
I guess my question was wrong with it.
What's wrong with WCM?
Yeah,
It's, for the last several years, it's been at the bottom of the performance of all of the index. This year, it's over 11% less than the index, 11.3%. You know, there's no, when you have a fund, you have a chance it's gonna do better, you have a chance it's gonna do worse, right? Just because it did in the past is no predictor of the future. It's the
Right.
tenet of all investments. So, yeah, it had a couple great years 4 or 5 years ago, but the last couple years, it's not done well. And
Just take a look at their ranks for me. On the 3-year basis, they're 4th as compared to their peers. And on a 5-year basis, they're number 1 as compared to their peers.
yeah, but that was,
So I think it's pretty disingenuous
That
to
was a
say
couple
they
years
haven't
ago.
done, but they're still their trailing numbers. I mean, if you wanna haggle over the short-term stuff, yeah, that's fine.
because it,
But you're gonna go through cycles, right? Growth's gonna be in favor, value's gonna be in favor. A market cycle is 3 to 5 years. It's not 2 quarters. Because we could look at your index and say, look at Vanguard, the total stock index, 78th for the quarter, 63rd for the fiscal year. Well, we're coming out of a momentum period. Maybe the index goes through a period now where it doesn't do well. I mean, markets go through cycles. That's why we look at longer-term numbers.
yeah, but we could
But
just
at
own
the
them
end
all.
of the day, I mean, you know, that's up to you guys. I mean,
I'd be concerned in our current economic conditions and financial conditions, both nationally and internationally, is making a change in horses right now. That's my concern.
yeah, I mean, they tend to stick to companies that have very low debt, you know, on their balance sheets, that tend to be pretty nimble through markets, very light, kind of, you know, not capital intensive. A lot of, you know, software and technology, the expenses kind of developers, and that's easy to scale up and scale down. But again, at the end of the day, that's up to you all.
I wouldn't want to do that right now.
I'll make a motion to redeem the WCM Focus International Growth Fund and invest it in the Vanguard Total Stock International Fund.
Okay, we have a motion. Do I have a second? I have a motion.
One of these days.
No second. Motion fails.
All right.
And then the only other item that I had for you all was just an update through August. So July was very strong. We got about 9% out of the S&P, but then we gave some of it back in August. So on the fiscal year through, again, August 31st, we're down about 10.8 at this point in time.
This is the other little booklet, right?
Yes.
Yeah.
Oh, okay,
Yeah.
thank you.
Yeah.
Just giving kind of
I was looking around and nobody was looking at
fresh
that, so-
update, if you will, through August. I have you guys down about 10.8 on the fiscal at this point in time, which is slightly better than what we saw in June. Still very red, negative, very red, but slightly better because of a strong July than where we were in June.
And what's MTH, that's month?
Yes, it is. Yep, so
That's
that
for the
puts you
month?
down, you know, but July was very strong, so it's kind of counterintuitive to look at that. You were down about 3.8 for the month. But July, you were positive, and so the net effect of that was actually made your numbers a little bit better.
So once again, WCM is kind of not doing well.
Anything else for me?
No, thank you very much.
Okay.
Thank you.
Thank you. Please excuse me. I usually stay with you guys, but I actually have an obligation this evening, so I am going to leave. But Chrissy said she would fill me in if I miss anything or if anything comes up in my absence.
Great,
Thank you for the time. Great to see you all.
Our feelings are hurt.
I'll make it up to you next time. I'll bring treats next time.
All right, moving on.
This is the police department, you bring donuts.
Scott, I'll turn it over to you.
Okay, let's see what I've got on my list today. First of all, I did check online for the financial disclosure forms, and everybody has filed their form, including Greg Angelonis, so that's good. Jim wasn't listed, but you came on after the first of the year, and I think we already confirmed with you that you had filed your form, so you're in good shape. So that means that nobody's going to be paying any fines, so that's a good thing. Next item I have is to just confirm I think Chrissy gave you a copy of the updated memo for the meeting dates for next year. I think you all approved those meeting dates at the last meeting, but I updated that December meeting. Remember, we moved it a week, and so that new memo essentially lays out all of the dates for next year. So I think we're good to go as far as our set times for meeting. We also, since at the last meeting, you approved some fee changes for both Foster and Foster the actuary. You recall a whole schedule, and you authorized me to do a new contract with them, not just an addendum to their contract, but a new contract, which I did. I also did an addendum to the Foster and Foster administrator contract, and we also changed the fee of that AMCO that you all had approved for AMCO. So all those have been done, and hopefully we have them here today, and they either will be signed or have been signed. So that means that little project is taken care of, and we're good to go there. We already talked about the ordinance status on the ad hoc COLA, right? So everybody remembers what we said there is essentially the city is going to look at all three plans and hopefully do something for everybody at the same time. But I did explain to the city manager and Kristen that if we move into the next fiscal year, the study that the actuary did for our ad hoc COLA would actually have to be updated because we're in a new fiscal year. And but they were okay with that. So that's we'll wait and see what happens there. Let's see. I guess the only other thing is the form that you've got, the memo and the form, pension form 30, the new form. I assume that one made the package too. This is not a huge deal, and it doesn't happen that often, and it's going to happen less often here because it has to do with share plan balances. And I know that I think last year was the first time we ended up having balances, and they're probably very small. But this form is designed to take care of a situation where we have a member who terminates his employment and he's vested. Okay, now if you recall what vested means, it means that you have worked here long enough such that if you terminate employment, you have a right to get a benefit other than just a refund of your contributions, right? So if I'm vested and I terminate employment, I do have a right to get my share balance after the next, at the end of the next fiscal year, okay, because you get another share distribution and you get a return on your share balance, and then you have a right to get your share balance. And obviously you're not getting your other benefits yet because you potentially have to wait years before you can start to get your monthly benefit, but you do have a right to get your share balance. But I've had the situation happen where if somebody does that, they get their share distribution, and then because they're terminated vested, they say, well, I want to get back my own contributions. I don't want to wait for my benefit. Well, technically speaking and legally speaking, once you receive your share balance, you have gotten a benefit from the pension plan. And so once you get a benefit from the pension plan, you can't get back your own contributions. So what this form is designed to do is to let anyone know who leaves with a terminated vested benefit that if they, number one, if they receive immediately a refund of their contributions, then they don't get their share plan or share balance. That's clear in the plan. Also, though, if they get their share balance, which the plan provides for, then they can't get a refund of their contributions because they've already started to receive benefits from the plan. So the only thing they can do is wait till their otherwise normal or early retirement date, which, you know, theoretically that's what they should be doing anyway, but they'd have to wait. They couldn't take back their own money because they've already started to get benefits. And this form is designed to have a member who fits into this category sign the form acknowledging that they understand this situation. So we're kind of avoiding the potential for some litigation. So that's the reason behind the form. I don't think you have to take any action, or hopefully you understand why I did it.
Has it happened in the past?
I'm sorry?
Has this scenario happened in the past? And this is why
I don't know if
coming
it's
up?
happened here, but it's happened in a number of my other clients. So as a result of that, I wanted to cover it for everybody. And so that's why I did what I did. It's only police and fire. General doesn't have share plans. So I don't think you have to take any action. I just wanted you to be aware of it. And hopefully Chrissy will provide that form to anybody who fits into that category and terminates employment vested. So that's really all I've got on my list, unless anybody's got any questions of me on anything I talked about or anything else.
I do have one question for you.
Okay?
The drop has moved to 8 years for other employees, county, state. Is our plan eligible to move to that?
You mean, can we do it?
Yes.
The answer is yes, okay? What he's talking about is they actually changed FRS, and FRS had a 5-year drop. Everyone knows what the drop is, right? The 5-year drop, and essentially what they did is, and it's a temporary change. It actually goes back to 5 years. I think when you get to 2028 or something like that, it goes back to 5 years. But what they did is they provided that going forward until 2028, anybody that goes into the drop can go in for 8 years rather than 5 years. And I think what they're trying to do, obviously, is to encourage employees, long-term employees who they're having trouble replacing when they leave. They're trying to get them to stay another 3 years, and this extension in the drop would allow them to do that and work that another 3 years. Can we do it in our plan? The answer is yes. I don't know whether it would need to be negotiated, but yeah, I have a number of plans already that either had it already 8 years, or just recently we've made the change to go to 8 years. And there's several different iterations about going to 8 years. We have some that say that regardless of whatever for the additional 3 years, regardless of whatever choice you made with regard to your return on your drop account, for the last 3 years you can only do the plan return. I don't know I can't remember whether we have the choice here. The actual plan return, the net plan return. do we have net plan return or the flat rate here? Or do we just have plan return? I should know that, right? But there's more than one way. What I'm saying is that there's a number of choices to make if we wanted to go to the 8 years.
It wouldn't cost us anything.
Well, I used to say no, it wouldn't, but actually the actuary said, depending on what assumptions they're currently using for retirement, that if you extended it to 8 years, it may have a small impact. So we'd have to get an answer from the actuary
It's
on
gotta be de
that.
minimis, though, I mean,
It
'cause you're
would
paying
be
it
small.
regardless whether they're working or not, it has nothing to do with the pension.
It would be small, but they might have to change the assumption about when people would leave, and
Oh.
that could change the.
Like they
the
might
funding-
retire earlier?
the funding. Well,
Or later?
retire later. Oh, yeah, retire earlier, because they could
Retire
stay
earlier,
for
they could
8
stay for
years,
another 8 years,
yeah.
yeah.
And if they leave earlier, they could have an impact. So, anyway, that's actuarial, that's not legal,
Yeah.
but, yeah, I used to quickly say, yeah, there wouldn't be any impact, but I actually got corrected at a meeting by the actuary, and I don't say that anymore. So, anyway, the answer is yes,
Do we have to vote
could
on,
do 8 years.
do we vote on that change? Is
We-
that something that?
we
that
who?
That's something that we would,
Or is that something that has to be negotiated?
Again, I don't know what the cost would be. It is a, quote, change in benefit. Technically speaking,
gotta be super small,
it's
though. I mean,
an
just-
optional form of benefit, right? I mean, it's basically, you're getting your benefit in a different form. So, I mean, I could make an argument that it's not a change, but I've had unions and cities say, oh, no, this is a change that has to be negotiated. Now, of course, if the city was okay with it and the union was okay with it without negotiating and said, yeah, let's do it, that's fine too, but that doesn't happen so much anymore. It used to happen all the time. But the answer is yes, we could do it, Chris, if the union wants to bring it up. And how close are you to the end of your contract?
I'm halfway
Yeah,
right now, but it wasn't even me that brought it up.
yeah.
It's just that the next day.
So you got a long answer to the question, which is, yes, we could do it.
Yes.
Sorry about that.
Okay, so to move that forward, we would have to address it with the union first, or can it be addressed here first?
Well, of course, the pension board can always make a recommendation. So if you all wanted to do an ordinance to change it to the drop to 8 years, leaving, we could leave all the rest of the stuff the same and just say, instead of 5 years, it's 8 years. We could do that. We'd have to have the actuary take a look at it and tell us whether there'd be any costs associated with it. But as you know, the pension board can always make recommendations to the city slash union for changes in the pension plan. But the city may well say, that's negotiable.
But how's where does the fire department in the city itself fall?
I don't know, because I don't do the fire.
Okay.
Yeah.
They're 5?
They're 5? Yeah, okay.
is this something the police officers want? Has this been discussed in your group?
It's something that's been brought up only because surrounding agencies have moved to it. It's something that's been offered to them, and of course, when one agency gets it, it spreads around and everyone wants it.
Okay.
Well, FRS is all state and county employees, so the sheriffs, all the sheriffs now have it.
Well, let's just make a motion to do it then. It's not really, the cost is de minimis. I mean, whatever it is, it's gotta be, I'm not
So you want me to
concerned. It
do
doesn't cost the city
an
anymore.
ordinance?
It doesn't
And
co-
you want me to prepare an ordinance to change the drop to 8 years? Is that what you're saying?
What
I
you
would
guys
like
want?
to see that.
Okay, let's,
That's a
yes.
motion?
Maybe you guys make a motion.
Do you want to go ahead and get the actuaries involved first before we make a motion on this? Before we vote on it?
You could authorize me to send the proposed ordinance to the actuary for a cost.
I think that would be good.
Aren't they
Include
gonna-
that in the motion.
Yeah. Aren't they gonna do it though? We're gonna do an actuarial study at the end of the month, right? Don't we do one every year?
No, that's the valuation.
The valuation,
Yeah, that's,
would it be worked into that, so,
no.
no.
So I would like to make that motion. Scott, you prepare
Did you
that.
get that, Chrissy?
From what I'm hearing, the motion is to authorize the plan attorney to draft the ordinance amendment extending the drop participation period from 5 years to 8 years, and then send it to Patrick, the actuary, to prepare an actuarial impact statement. Is that
Well
correct?
Or at least a study.
Or study?
Yeah, we don't really need an impact statement yet.
I'll second that.
Okay, I have a motion and a second. Any further discussion? All in favor signify by saying aye.
Aye.
All opposed? Motion carries.
Done.
Chrissy?
Okay, the state monies were received on, and deposited on August 29th of this year. The plan received $240,904.56 this year, which was 7.8% more than last year, which is the equivalent of $17,467.06 more than the prior year, so that's great. And I just included this page that this partial history of premium tax refunds is a page out of the valuation. I just think it's really interesting to see the progression of state monies and kind of how the amounts have changed over time. So I included that today. Educational opportunities. I've got Sam registered to attend the upcoming Fall Trustees School. Is there anyone else who wanted to attend? If so, please let me know as soon as possible. I don't think the discounted hotel rate is still in effect, but registration is still open. So if anyone else wants to go, let me know.
What are the dates on those again, Christie?
That is October 2nd through the 5th.
6th, okay. Yeah, can I get you to send me information on that? 'Cause my schedule just changed. I was gonna be in Texas.
So I usually go once a year to these, right? And I usually go to the winter school, but it's really hard to go in February for me because a lot of clients are down and it's busy. So I'm switching it to October before season starts, and I'll do that going forward.
I think there's another one as well. Oh, yeah, and the Division of Retirement Conference also, that's actually taking place first. I'm sorry for overlooking that. That's September 26th through the 28th in Orlando. That one is free to attend, so if you're able to attend, just let me know and I'll send you the link. You'll register yourself, book your own hotel room, send me your hotel receipt, and we'll get started on the reimbursement process for you. Do any of you guys know if you want to attend or plan to attend the Division of Retirement?
Can you send me that too?
Sure.
Okay. Let me take a look at my schedule, see if that fits.
And the only other thing I wanted to add is that, and Scott mentioned earlier, you did approve the new fees for Foster and Foster for administrative and actuarial services. Those fees will take effect 10/1, so be on the lookout for those new amounts on the invoices. And that is all I have.
Very good. Any further discussion from the board? Excellent. That will conclude our meeting. Next meeting will be December 15th, 2022 at 1:30 p.m. Here at the Military Heritage Museum. Thank you very much.
Hey, Sam?
Yeah.
I had on my reappointment, volunteer from the city council has a personal vendetta against him. So when it came with my appointment, he said, I want him rejected. Never gonna second it.